Switching back to the major indexes, joining me now on set is David Stryzewski, CEO of the independent insurance firm Sound Planning Group. David, thanks for joining me on the floor.
Thanks for being here. I'm blessed to be here.
We're great to have you in person all the way here from the West Coast. And let's talk about on a mixed market day, as our viewers see on the screen here. What's your take? Where do stocks go from here?
Okay, so where we are right now is likely to be considered the calm before the storm. Now, I don't like this to share this information like this. I'm not generally bearish. I'm just someone who is looking at the data and trying to understand how to make heads and tails of things. And so where we go from here, well, I think that we're ultimately seeing the earnings coming down. I think that they're just too high at 20 times. We're looking at the banking challenges that even the Fed said were unexpected. I believe that, it would be a big mistake to say that we're out of this financial crisis as it relates to banking right now, when so much money has left these financial institutions that they were borrowing 10 to 1 on. For every 100,000 in, they can make $1 million of loans. Those small and mid-sized regional banks are 70% of all corporate financing. So if they don't have the money to borrow to those corporations out there, and the corporations are going to be borrowing at a higher rate, this spells major challenges for the future, especially given all the headwinds that are facing us. So
it is interesting because we do know there's a lot of money on the sidelines, right? Yes. That I think does want to be put to work somewhere, maybe yielding more than a 4 or 5% on a CD, when the stock market on average is up, let's say 6 or 7% a year. But what would you advise investors? I mean, should they be picking and choosing stocks here? Do international markets look more opportunistic? What's an investor to do?
Okay, so we need some I know so money and then some I hope so money. So finding the right balance on that is based upon someone's tummy test, right? And so where do we go today? Well, I would say that it's going to be more intelligent to be in individual names as opposed to just buying the whole market as there's going to be some rising, some falling. I think that it's really important right now that investors are looking at bonds, because bonds are actually, there's 5 ways that bonds can lose money. And so I'm actually pretty bearish on bonds right now. And the reason for that is because, the banks are in trouble today because of the interest rates rising and the seesaw effect. That's just one of 5 ways that bonds lose money. And so, interest rates rise, value of those bonds go down, they're forced to sell them and liquidate, now they have big losses. Alternatives to bonds are really important to be addressing today. One of my better ideas as well, I think, is actually looking at gold and silver. Specifically silver, because of the ratio of 83 ounces of silver for 1 ounce of gold. That's today's measurements. And so if we actually look at supply and demand, they can create 9 silver for every 1 gold. And so that's a wonderful opportunity right there to pick up some arbitrage, even in the miners. Mm-hmm. As we're looking at different alternatives and opportunities today, I don't think it's a time to be complacent. I think if we had great ideas in the times past, they're potentially some of the best ideas going forward, but likely we need to change our thesis. We need to evaluate what's going on, all these headwinds that are taking place here.
Well, let's talk about the debt ceiling deadline, right? Sure. June 1st, the U.S. could default on its debt if a deal is not reached, though both sides have been generally optimistic, still without a deal, right, that we can get to a deal before that actual deadline. How does that factor into someone's investing thesis?
Okay, so the debt ceiling is a really big deal because the United States is the world's reserve currency. And so what this is doing for sure is causing many investors around the world to lose faith in the United States. And if they lose faith in the United States dollar, and let's just say somehow this BRICS dollar that Brazil, Russia, India, China, South Africa, Saudi Arabia, Iran are going to be involved with, if they gain prominence, specifically in trading oil and other assets, then it's going to cost more if we are less creditworthy. Also, in 2011, we saw, a downgrade for the United States. We went from AAA rated to AA rated. We're in the exact same position right now as we were back then, as we're sitting here with political stalemate, higher debt to GDP situations. Oh, by the way, we've got the largest segment of our population being baby boomers that are all retiring right now. Yeah. And that's over 60% of all federal spending today is Medicare and Social Security payments. So, this federal debt ceiling doesn't get fixed in a moment. It's got big challenges ahead of it.
Is there an easy thing to blame, maybe other than COVID generally, for the place that we're in and perhaps where we're heading?
The cost of capital is our biggest issue right now. And so Jerome Powell raising rates as fast as he did and missing it completely missing it and saying inflation's transitory in 2020. And then prior to that, in 2019, he dropped rates to those record lows that we saw. So that's really the culprit here, because when we change the cost of capital so significant, so quickly, we find ourselves with big issues, because let's just face it, our whole world runs on capital right now and how much we can borrow.
Right. All right, David Stryzewski, CEO of Sound Planning Group, in from the Seattle area. David, thank you.
Thank you.